Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, March 16th, and today's theme is simple. When energy gets weird, everything gets expensive, and the Fed gets a headache.
Energy is doing that thing where it walks into the room and suddenly everyone's budget starts sweating. My grocery bill heard oil above $100 and immediately applied for overtime.
We'll cover 4 moves. 1. Iran war risks sharpening Fed divisions over rate cuts. 2. The Strait of Hormuz shipping pause and what that does to oil. 3. Why chip supply is now part of the same story. And 4. The markets are complacent warning. What to do with that as a normal investor.
The world's most stressful group project. Geopolitics, inflation, rates, and your retirement account. Just added a new teammate named Chaos.
Story 1. The Fed is expected to hold rates steady this week, but officials are split because the Iran conflict adds fresh economic risk, mainly through energy prices and inflation expectations. In plain English, even if the domestic data is okay, war can import inflation through the stuff we burn and ship.
So the Fed is like, we'd love to cut, but oil is like, not on my watch. It's basically your thermostat fighting your roommate who keeps opening windows in winter.
Exactly. The finance behind it, rate cuts are easier when inflation is cooling and predictable, but energy shocks can raise headline inflation quickly. And even if core inflation is steadier, consumers feel gas and heating first, so expectations can drift up, which the Fed hates.
And expectations are like group chat rumors. Once people believe prices will rise, everybody starts pre-buying, demanding raises, and suddenly the rumor becomes the plot.
Why it matters for normal people. If the Fed stays higher for longer because of energy risk, borrowing costs stay elevated. Mortgages, auto loans, credit cards. If you're refinancing or buying a car, this is the difference between fine and why is my payment a small rent?
So, practical move, if you have variable rate debt, you don't need a crystal ball. You need a plan. Lock what you can, build a bigger cash buffer, and stop financing vacations like they're capital projects.
Story 2. The Strait of Hormuz. We saw reports of a first full day where no ships crossed amid the Iran war. Even the possibility of disruption at a choke point matters because a large share of global oil flows through there, so markets price in scarcity fast.
It's basically the world's narrowest do not disturb sign. One little lane gets tense, and suddenly every airline, shipping company, and delivery fee starts acting possessed.
Here's the simple version. Oil prices aren't just about today's barrels. They're about the odds of future barrels arriving. When the odds get worse, you pay an insurance premium. Higher spot prices, higher futures, higher shipping insurance, and sometimes panic buying by refiners.
So the market is paying for maybe, which is relatable. I also pay for maybe when I add the refundable hotel option. Except this time, the refundable option is a $100 barrel.
Actionable angle. If energy spikes, it hits your life twice, directly at the pump and indirectly through everything delivered. For investors, that means don't treat broad market risk as one blob. Energy-sensitive sectors and inflation-sensitive assets can behave very differently week to week.
And for households, this is the moment to do the unsexy stuff. Check your commute, batch errands, review your utility plan. You can't negotiate with geopolitics, but you can negotiate with your own habits.
Story 3. The conflict is also casting doubt on global chip supply, with concerns it could choke off key supplies for chip making and raise power costs in Taiwan. Critical because Taiwan is central to advanced semiconductor manufacturing.
So it's not just gas is pricey. It's your phone, your car, your washing machine potentially gets pricier or delayed. Oil drama walked, so chip drama could run.
Finance mechanics. Semiconductors are a bottleneck input. When a bottleneck tightens, companies either pay up, pass costs on, or slow production. That can keep goods inflation sticky even if demand cools. Another reason central banks get cautious about cutting.
It's basically like trying to cook dinner when one ingredient, say eggs, vanishes. You can substitute, sure, but your pancake era is over, and now everything costs more and tastes like compromise.
Story 4. Strategists are warning markets may be a bit complacent about the Iran war. Translation: prices can look calm until they're not, especially when risks are binary, like shipping lanes reopening versus staying impaired.
Complacent markets are like a friend texting, "I'm chill," while they're clearly typing in all caps. The calm is suspiciously calm.
Action steps without pretending to time the news. 1. Revisit position sizing. If a single headline can move your portfolio a month's progress in a day, it's too big. 2. Diversify across inflation regimes. Think a mix that doesn't rely on rate cuts to work. 3. Keep dry powder for volatility instead of chasing every spike.
And emotionally, stop doom refreshing. If your strategy is panic at 2 a.m. and sell at the bottom, congratulations. You've invented the world's most consistent way to underperform.
Quick recap. War-driven energy risk can delay rate cuts. The Strait of Hormuz is a pricing lever for oil and shipping costs. Chip supply risk is a second-order inflation channel, and markets can look calm right before they reprice. If you want more daily clarity, subscribe and share the show.
Drop a comment with your real-life question. What should I change this week? Budget, debt, investing. Pick one. And if you're about to make a big purchase, maybe don't do it on the same day oil decides to audition for a superhero origin story.
That's it for 2026, March 16th. This is BD Daily Finance News Podcast, your daily briefing on finance and investing. See you tomorrow.